we've seen a very, very fundamental shift in the sentiment around Bitcoin. We saw precious metals run, right? We saw that happen, and we saw the narrative around Bitcoin be challenged in a sense of, well, I think you thought, many people thought that 2026, because of all the institutional adoption, because of all of the treasury companies, because of all the positives that we had, 2026 would be a year to buck the trend. As we see, that's not the case.
Hey everybody, welcome back. This week I have on Adrian. Adrian, welcome.
Joe, good to be here. We had a great conversation last time, so I'm very excited about this one.
Absolutely. There's a lot to talk about. One, I want to cover your paper that's kind of analyzing and thinking about market sentiment and how we price basically everything. But first, let's talk about current market conditions and then maybe we can tie current market conditions into like how you think about markets in general. But what's going on in the Bitcoin market? It's very interesting and volatile times.
Yeah, it definitely is. So, how should I start? Well, we had October 10th, right? We hit 126 and change, and then the liquidation event happened, and we all know what the price action that resulted from it was, right? And I think that we are still working through that, even though we are now in April 26th, and that was in October 25. I definitely think it took a big chunk out of the momentum that we had building, and it essentially killed the momentum. And what's been going on since then, we have, and this is not me getting political, but we have the situation with Iran in the Middle East. We have, oil prices. We have what seems to be a bit of a credit crisis blooming a little bit. But right now we have a few other macroeconomic factors that are not currently ideal, and it seems like the market is trying to figure out what's next. But because, and again, this is not me getting political, it seems that we are one post away from the market taking a swing in either direction. The volatility has greatly increased in the overall market, and there's really nowhere to hide. Is the best way I can say it. People that are heavy equities, they're getting killed. People that were heavy oil, they're profiting today, but they're getting killed just yesterday and days before. It's been a wild seesaw. People that are in metals, they saw a run up and now they're getting drilled. There really is nowhere for the liquidity and the capital to flow. And the way I think of volatility is that people love to give a statistical definition for it, but really the best way to think of it is tension. The tension that exists between positioning and markets, that space in between the bulls and the bears, between the longs and the shorts, that's the volatility. And right now, that the market is fighting, and what we're seeing is a result of that fight. And the volatility has been spiking at different times; it's been dropping at other times. But the positioning in the market right now is very, very crazy because I don't think anyone can make heads or tails of where the market's going, and the volatility that we're seeing is the result.
Yeah, it makes sense. And with energy prices soaring, it kind of makes sense that there's nowhere to hide. I mean, if that's like the base input to virtually everything, you know, in a way, society gets poorer if that gets incredibly scarce really fast. So it's unfortunate, but long term, I think there's a lot of good reasons to be optimistic, especially about Bitcoin. I want to dive into your paper and kind of how you think about markets very broadly. Your paper is all about market sentiment. Why did you decide to write this paper?
Well, I think you're aware of this because we've talked about this in the past. I'm of the mindset that, and the belief that markets move on sentiment, right? And the thing about sentiment is people think that sentiment is emotion, but it really isn't. Sentiment is something far more specific. If we think about emotion, when you hear the word emotion, that means to emote. That means what you're showing to people, right? It is a very front-facing, public-facing event. Feeling is more subjective. Sentiment is a mixture of what I've kind of defined very, very functionally as perception, judgment, and conviction. So perception is how we perceive the market, obviously, and all of our personal biases, all of our experiences, our emotions, our feelings, our thoughts, our subjective leanings, all of that feeds into how we perceive either an equity, an asset, commodity, what have you. We're not doing that in a vacuum. Perception then leads to judgment. Judgment is what we then base our decisions on, based on our perceptions. That allows us to make decisions on what we perceive, make decisions on what we think, make decisions on how we perhaps want to allocate capital. If you think of perception as the filter for the market, judgment allows us to apply that filter towards the decision making process. And then conviction is the last step. We can have perceptions and judgments about the market, but it really means nothing until allocation of capital takes place. And without that last bit of conviction, the decision to actually make that allocation of capital, our sentiment doesn't impact the market. So that's why I say that saying sentiment is emotion or feeling is a very, very incomplete definition. And we need to think of sentiment more broadly in terms of perception, judgment, and conviction. And the reason why all of that is very, very important is because, and this is the fundamental question that I ask everyone, and like talk through it with me because I always like going through this thought experiment. Can we know the future? I think both of us would agree that we can, right?
No.
But by the same measure, markets are forward looking. Every allocation of capital that we make today is for an outcome tomorrow, very, very broadly speaking, right? So then help me understand, and I'm saying this, rhetorically, but to facilitate the conversation. If markets are forward looking, but we cannot know the future, what objective information could actually inform the decisions that we're making today that comes from the future? It's obviously impossible. Therefore, fundamentally, the allocation of capital in markets cannot be objective. It is a forward facing, future facing, forward looking allocation, but we cannot possibly make it an objective decision because it cannot objectively be informed by future facts. And sentiment, perception, judgment, and conviction is what we use to bridge that temporal gap between today and tomorrow. That is how we make the decision. That is how we allocate the capital. That is how we make sense of uncertainty.
I like that. I pretty much completely agree with everything you just said. I think that that makes a lot of sense. Maybe even like at a higher level, or slightly, maybe even slightly narrower level, actually. Like, so that's how the market or individuals think about pricing and acting and allocating capital. Why is this interesting from the perspective of like someone that holds Bitcoin or someone that holds, Bitcoin treasury companies or digital credit?
Well, if the market moves on sentiment, what was the hot topic all last year? mNAV, right? People were saying that in the case of strategy, Sailor is hitting the ATM and he's killing mNAV, and Metaplan had a crazy mNAV at one point that just blew out, and everyone was very, very euphoric, right? People were coming out with forward mNAV and all kinds of other analytics trying to project mNAV forward, saying that if mNAV is this, and they can mechanically issue shares, and if Bitcoin does this and Bitcoin does that, the mNAV will be X, and we will see this price, and so on and so forth. But as we saw, all of those predictions were all for naught. And the reason why sentiment is very, very important is because, again, holding it constant, if markets are forward looking, mNAV by definition will also be sentiment as well. And the same that would hold true for a PE ratio. The same will hold true for a price to book value. The same will hold true for any kind of valuation metric, because and again, my essay is about sentiment, but it goes, as you know, it goes very, very deep into everything, right? So if we think about valuation, and I'll focus on this and then I'll come to Bitcoin. If we think about valuation, if we use the Bitcoin treasury companies as an example, whether we want to use mNAV, which focuses on net asset value, or mNAV that focuses on enterprise value, the only thing that is objective, the only thing that is fundamental, is what I like to call the anchor of one. So what that means is your net asset value of your Bitcoin holdings, whatever dollar amount that is the fundamental value of your company, right? And I'm not saying that's justified. I'm just saying mathematically, that would be the fundamental value of your company is your net asset value. If we're using mNAV as a barometer for valuation, the NAV, the net asset value, would be the fundamental value of your company. So what that means is when you have an mNAV of 1, 1.5, 2, 3, so on and so on and so forth, the market is paying a premium to your net asset value. However, fundamentally, the only thing you can justify from a valuation standpoint, whether we want to accept it or not, is that 1-to-1 ratio between net asset value and valuation. And this was why it was such a hot button topic because mNAV was much higher than NAV, obviously, it was a multiple, and people thought it was unjustified for a variety of reasons. What we saw in the contraction of mNAV was sentiment essentially unwinding, is the simplest way I can put it. The sentiment in the entire space was shifting. If everyone thought that mNAV was supposed to be 3, they were allocating capital that way. But then as Bitcoin's price started to dive and as the other price and other market factors came into effect, we saw the mNAV for strategy, we saw the mNAV for MetaPlanet, we saw the mNAV for other companies slowly but surely tick down as sentiment shifted. And the reason why I think people need to understand that the role of sentiment in the market is because, again, what objective reason do you have for paying 3 times or 2 times net asset value for a Bitcoin treasury company? Or in the case of a traditional equity, 15 times the PE ratio, 30, 40, 60, 70. There's no objective justification for that. That is a forward facing decision of what you think it will be worth. And now that we have seen what happens when the market no longer thinks they are worth a multiple, that is a price action that we see today. It does not mean that these are bad companies. It just means that the market's current perception of them is saying that they should be trading closer to net asset value. Coming to Bitcoin, Bitcoin's sentiment and what we saw with the October 10th, liquidation event and everything since then with the geopolitical events that we're seeing and so forth, we've seen a very, very fundamental shift in the sentiment around Bitcoin. We saw precious metals run, right? We saw that happen. And we saw the narrative around Bitcoin be challenged in a sense of, well, I think you thought, many people thought that 2026, because of all the institutional adoption, because of all of the treasury companies, because of all the positives that we had, 2026 would be a year to buck the trend. As we see, that's not the case. And Bitcoin is as dependent upon sentiment as anything else. And a very concrete example I can give of that is if a Bitcoin miner, it costs them $50,000 to mine Bitcoin. People like to think of that as some kind of a fundamental floor to Bitcoin's valuation, but that's just a aspect of the cost of production, the cost of actually mining the Bitcoin. We've seen that the market will rate Bitcoin above or below the cost of production at various times. And again, I say to people, why is that? It's because markets are forward looking and the market doesn't care what it costs to mine that Bitcoin. It cares what it thinks Bitcoin should be worth. And what we see in the market, what we see kind of building and kind of the ebb and flow and the tension that exists in the market, the volatility in the market, the positioning in the market, all of that is derivative of sentiment. And we are right now just in a position where people that are less bullish on Bitcoin are in control. And it'll take time for narratives to shift, for sentiment to shift. And as a result of that, positioning will shift for the bulls to get back in control and the price will go up. But we will be in a constant ebb and flow between those two.
Hmm. So your paper subtitle is an expanded theory for markets and valuation. I completely agree with the idea that markets are forward looking. I think most people would obviously agree with that idea. What do you think is like the most new or even like controversial idea from the paper that you published?
Well, taking a step back, if markets are forward looking, and if we agree that because of that, there's no future information that could impact our current decision, and as a result, decisions can't be objective by definition. What that means is that valuation, so whether it be mNAV, whether it be PE, whether it be EBITDA driven, whether it be book value, all of those valuation metrics that we model out right now as statistical artifacts that we try to model in a variety of different ways, assuming that they're financial data, what it actually means is they are in fact sentiment data. Because if the actual multiple is a derivative of the market's future and forward facing sentiment, we potentially have an entirely different surface to analyze with these existing data sets that can be modeled a variety of different ways. That can be modeled in a way that sentiment data is modeled. So we can talk about contagion, we can talk about network effects, we can talk about clustering, we can talk about all kinds of different um, metrics that are typically reserved for sentiment data using existing metrics. And I've already started doing some analysis, and I could confidently say that the results have been rather eye-opening when you
Hmm.
model financial data using sentiment data focused modeling.
Hmm. And so I guess like very broadly, your concept is like there's not necessarily a correct way to value a company. It's impossible to value or anything correctly. Like there's just nothing correct. It's all sentiment based. Is that correct?
Yes, it is all sentiment based. Now, I want to be very, very specific here. Objective facts can inform our decisions, right? So I don't want to give the impression that it's all sentiment and there's no rhyme or reason to anything. That's not what I'm saying. What I'm saying is we have to be honest about what we can and what we cannot do. We cannot claim to make objective decisions about the future when the future is unknowable. So, what does that mean for valuation? It means that valuation must have a fundamental understanding that it is subjective, that it is narrative driven, and valuations are going to ebb and flow based upon that narrative and based upon sentiment. So, as a result, valuation has to be what I like to call informationally dense. So, you need to have as much information informing your forward looking decision to make it durable, to make your narrative durable. And a durable narrative, if you want a concrete example of that, has been NVIDIA, for example, right? And Bitcoin's been a durable narrative as well, but I'm going to come to that for a different reason. NVIDIA has been a durable narrative because ever since ChatGPT launched, people have been saying it's been a bubble every single year, every single quarter, over and over and over and over again. However, NVIDIA, even with this price action that we've seen with the S&P and the Mag 7 broadly selling off, NVIDIA was under $100 at one point last year. It's over 170 right now. I think people that bought under 100 last year and held to this point, they're fairly happy with their results. I know I am as a long-term NVIDIA holder from since 2020, end of 2022. So that is a durable narrative. That is a narrative that has withstood tariffs, Middle Eastern uncertainty, bubble accusations, deep seek, short and distort reports. We can go on and on and on. It's had several attacks on that narrative that have shown us to be rather durable, right? Now with Bitcoin, we'll go back even further. We all know about Bitcoin's inception. We all know that Bitcoin came out of the great financial crisis. We all know that Bitcoin is a direct response to what you and I obviously agree on is the scourge of fiat currency, right? Bitcoin has a durable narrative. However, it doesn't have a steady state narrative. And what I mean by that is the durable narratives around Bitcoin are, pristine, perfect money, anti-debasement, the benefit of having a fixed supply. We can go on and on and on and on and on about all of the narratives around Bitcoin, right? That have been fairly durable, but the steady narrative is the one that the market's going to agree on, and the market still hasn't agreed on the steady narrative because we have individuals like you and I that probably agree with Michael Saylor and other people in the space that have one set of narratives. We have other individuals that are saying that nope, Bitcoin is purely going to be statistics and network effects and network adoption. And they say because of the power law, Bitcoin should be X price, right? Then you have other individuals that came from the gold space and called Bitcoin digital gold, right? That's where that narrative started, and they think that there are correlations between Bitcoin and gold, and Bitcoin is a natural progression of gold, and it's digital gold, and it's a the future of money. It could be the future of a new Bitcoin hyper Bitcoinized world where the entire world is operating on Bitcoin, right? All of those narratives have been relatively durable, but none of them have been steady in the sense that the market hasn't latched on to that one narrative. And I think that is what Bitcoin is going through. We've gotten more adoption, we've got more players in the market, but more players in the market hasn't created a steady narrative. It's created a durable narrative, but not the steady one.
It makes sense. One thing in your paper that you mentioned that I really liked is you said that that traditional finance is a study of ripple effects that ignores who threw the stone.
Mhm.
Can you kind of explain like what you're trying to get across with that phrase?
Yes. So one of the opening of the paper, I distinguish between what is epistemological knowledge, in other words, the nature of knowledge and what we can know, and what is ontological, in the sense of what is necessary for action, right? Now, we can know whatever, right? So, with regards to valuation, with regards to how we look at equities, with regards to how we look at Bitcoin, we can have all kinds of knowledge about that, but that knowledge doesn't have any impact unless it takes effect in the market, right? And the reason why I use ripple effects and the reason why I say sentiment is the first cause is because coming back to my distinction of, perception, judgment, and conviction, once that triad takes effect and a person decides to allocate capital, that is the stone throw. And that stone throw has ripple effects. Now, if we aggregate that across all market actors, we can see how the effects of sentiment aggregate and it becomes a collective explosion of ripple effects that ripple through the market. And the problem with traditional finance is that it tends to look at the market as if it's some rational system that can be predicted, that can be thoroughly analyzed, that is fully objective. But as I've shown, and as I do show in my essay, that's actually fundamentally, logically not possible if markets are forward looking, right? So what
Hmm.
that means is everything that occurs in the market is downstream of sentiment. It is downstream of that stone throw, and it is downstream of those ripple effects. I go into a great deal of detail in the essay about all of the potential counterpoints to that. But one of the most common ones I get is what about like trading algorithms and algorithmic trading? And I like to make people aware that trading algorithms can act autonomously in the market, but they do not act independently in the market. A trading algorithm executes a sale, executes a buy, executes a transaction based upon rules. Not only are those rules driven by the humans that code them, so they have implicit bias and implicit subjective indications into how trading algorithms are coded. We can even pivot that off to, I'm sure you've used different LLMs and how different LLMs have different strengths, right? Why do you think that is? That is based upon the people that have coded them, that have developed them. That is the net result of that. That is why people swear by Claude for coding, right? But they swear by Gemini for conversation. And some people still swear by ChatGPT for math, right? It is a function of the subjective decision making process that developed those LLMs. So coming back to algorithms are trained, they operate off of historical data. So if all markets are forward looking and all markets are sentiment driven, and that is logically concise and that is logically correct, that means historical data, all it is the crystallization of prior sentiment. So on two levels right there, trading algorithms are not independent in the market, they're autonomous and they are driven by the decisions and assumptions of those that develop them. Two, they are operating off of historical data sets that are fundamentally sentiment laden because they are the crystallization of historical sentiment artifacts. And three, if they are not independent in the market and they are autonomous in the market, what an algorithm is they're a price taker, they're not a price setter. Price is set after sentiment's effects in the market take place. Therefore, the algorithm is reacting to that settlement. It is not setting the price. So algorithms are amplifying the effects of market sentiment through the market with high frequency trading at the speed of light. So algorithms, in fact, amplify sentiment. They do not eliminate it.
Hmm. Yeah, I think that that makes sense to me. So this idea of like sentiment being, like from an individual's perspective, based on like all past information and how kind of how the individual feels about the future, would you then say like sentiment is still like based on like fundamentals of like data and like how people are like looking at the world and analyzing the world, or would you disagree with that like that framework?
So this is where the nuance comes in, and that's why I say in my essay, informed analysis still matters. Fundamentals can inform sentiment; they don't eliminate it. Oh, to kind of highlight this and to explain it a little bit better, in the essay, I have a thought experiment called the blind ledger. Right now, let's say that you and I are analysts, we're market analysts, and we're looking at a company. They have pristine financials. They have cash on hand. They have no debt. They have had 20% growth year over year for the last, let's say, 4 years, right? However, we do not know the name of the company. We do not know the industry. We do not know anything narratively about the company besides the numbers. How do we assign a value to those fundamentals? There's no way to do that without making assumptions, right? And you and I, if we separate and go into different rooms, we will come up with a different set of assumptions for that exact company based on that exact set of financial artifacts, based on that exact set of fundamentals. We will have divergent opinions on what that means without narrative context. We would have no choice but to either do one of two things: value it at parity with its valuation. So if it's net asset value, the only thing we could objectively justify is valuing it at net asset value. If it's earnings based, we can only value it at earnings. We cannot assign a multiple with no narrative justification. And the narrative justification comes from the company is NVIDIA, the company is Palantir, the company is Tesla, the company is Strategy. That is what's giving us the impetus to assign a forward multiple on it. And that is why I tell people fundamentals, they only go so far, because the only thing fundamentals can justify is what I like to call natural parity or historical parity. So natural parity is at value. And what I mean by at value, whether it, and kind of like I described in the past, in the previous conversation we were having when I was teeing this up, at value means at net asset value, at enterprise value, at earnings, at whatever. That is the only thing that we can objectively justify. Anything that gives a valuation above that is a forward looking, sentiment driven assessment. It cannot be objectively justified. And parity, the reason why in my essay I call parity the anchor of one, is that a multiple fundamentally, when people say mNAV is 3, when people say PE is 30, what that multiple is, it is a multiple of a base unit. And fundamentally, that base unit in valuation is always parity with value, whether that be net asset value, whether that be earnings, whether that be whatever. So fundamentals can inform the decision, but it doesn't justify forward looking assessments. It informs them. It cannot make them objective. They are still sentiment driven, they're still sentiment
Mhm.
derived.
I agree with that. I think that that makes sense. How about like in your example of like this company that we know nothing about, but you can kind of look at the financial statements. What if you could, could there be an argument that okay, this company, say the current price that it's trading at is 1x mNAV, but it's of various assets, doesn't have to be Bitcoin related, but its PE ratio is 30. Like if there's a divergence between like two valuation methods, like how do you think about that?
Well, and that's why I make a distinction between natural parity and historical parity. Historical parity, if you take a look at the market as a whole, if we look at PE ratios, the historical parity, um, I define it as that historical marker of what the market's typical PE ratio is. So in the case of I think in the last, I don't know, we can say 30 years, it's been between 15 and 17. And in the essay, I say that the market convention for PE ratios is 15. Now, the only thing you can fall back on in the example I'm giving, if you think about it, if you have no other information about the company, the only thing you can fall back on is what you know. And the market convention is a PE ratio of around 15. Now, in your example, you say that, well, if the company has a valuation of a 30 PE valuation, right? Well, is that really a true fundamental look at the company? If you're trying to assess a company, but you're already assessing it with a forward-looking valuation, you're not being objective. That forward-looking valuation is going to impact your decision. The only thing you can look at if you want a truly fundamental, fully objective assessment is the information of the company itself. No forward-facing assumptions can inform your decision because, as we said, you cannot know the future. So if the company has a current PE of 30, you cannot then say that you're going to assume that a similar PE is going to carry forward into the future if we've already established that no future-facing information can inform your decision today. So that would be almost like you're saying it's trading at a PE, a PE of 30 right now. So I'm just going to say that, well, that means it should trade at a PE of 30 going forward. That's not an objective decision. That's
Yeah.
falling back on what I like to call historical, like a market convention or historical parity. You have history that justifies that PE, so you're assuming it can go forward.
Yeah. And with things like AI and just how fast the world is changing, past data may not be, maybe even less indicative of future data. It might be even harder to predict the future than it was in the past, which is kind of interesting. What do you think about this? Is kind of a related question, but I'm curious to hear how you think about this. Like I heard in the past that like Warren Buffett, something that he would do would be he would actually like look at the financial statements of various companies and he would not know anything about the company. He would just literally look at the financial statements and then he would try to come to a price based on like pretty much pure like fundamental analysis. And then he would, without looking at the current market price, and then he would go back and look at the current market price and be like, oh, like I'll buy this, or oh, like this thing's way overvalued. Do you think that like that's a good idea to think about stocks and investing in general, or is that just kind of like an outdated way to think about everything?
Well, it's a very I don't want to use the term simplified. I would say it's a very logical way to look at valuation. So I've actually heard that about Warren Buffett, and that's what kind of that inspired my idea behind the blind ledger. I just took it a step further. My stance, and I think this holds up under scrutiny. If you are making a fundamental valuation, you cannot make any assumptions whatsoever. The only fundamental valuation can be at parity with the value of the company. A building is worth a building. 1,000 Bitcoin is worth 1,000 Bitcoin. If you had 100 million in earnings, you should be worth 100 million in earnings. Do you see what I'm saying? That is the
Hmm.
only truly fundamental, objective, non-sentiment, non-narrative driven valuation you can possibly have for a company. And that's why I call it the anchor of one, that one to one parity. Now, with what Warren Buffett is doing, there's value in that. What he is trying to do is he's trying to strip away as much outside noise as possible when he's looking at a company. However, what he's doing is fundamentally impossible because you're trying to tell me that a man with decades of experience in the market is going to look at a company with no bias whatsoever. He's going to have no perception, judgment, and conviction impacting his decision and how he looks at that. That's impossible. So while he may be making more informationally dense decisions because of his experience, while he may be making decisions that will have more disproportionate impact because of the size of a player that he is in the market, him allocating capital by itself is going to motivate the market to perhaps look at things differently. However, doing that doesn't eliminate sentiment. What you're trying to do is you're trying to constrain sentiment and trying to constrain subjectivity by that activity. But ironically enough, all you've done is you've removed external subjectivity and replaced it with your own
Hmm.
with doing that because you cannot possibly make that decision in a vacuum. It is going perception, judgment, and conviction. All of that's going to impact how you decide to allocate capital.
Makes sense. In the paper, you also talk about this, sentiment, but also reflexivity. Can you kind of like expand on, because I think that's very related, obviously, to both Bitcoin and Bitcoin treasury companies. Can you kind of expand on this idea of reflexivity and how it relates to sentiment?
Yeah, sure. So reflexivity, very, very simply, is a feedback loop that fuels the market, right? And this is me dumbing it down very, very much, but I think that the analogy will hold. You have people that are bullish on a stock, which makes the price go up, which attracts more people because the price is going up. And because the price is going up, you get more people and the price goes up higher, and the reflexivity tends to go that way. It also works in the opposite, right? People start selling off, the price goes down, it makes more people sell off, which makes the price go down further, which makes more people sell off. You see what I'm saying? So that is reflexivity. That is the feedback loop that occurs in the market. The distinction that I make, though, is that a feedback loop, by definition, can't self initiate. There's no way for a feedback loop just to start without any kind of action whatsoever. So even with reflexivity, sentiment serves as the initiator of the reflexive process. Without perception, judgment, and then conviction leading towards the allocation of capital, a feedback loop cannot start because a feedback loop can't self-initiate. So people that say that the market is reflexive, they are correct. They're not saying anything that's factually incorrect. But I think people forget that a feedback loop can't self-initiate. And what is the first cause? What is the first mover in that kind of a reflexive feedback loop? And in the markets today, that can be hedge funds, that can be individuals, that can be algorithms, like we saw on October 10th, right? That was a reflexive loop. The price sold off, and it created cascading liquidations that caused more people to sell off, and that was a very, very reflexive cycle that went through the market. It just happened in the opposite direction. So reflexivity is real. Cascading effects are real, but it still needs an initiator of action because a reflexive loop, a feedback loop, can't self-initiate.
Hmm. Would you say like the nature of both Bitcoin and just like the dollar monetary system, like being debt based, and Bitcoin, like, there are a lot of leverage traders of Bitcoin. Does that make markets more reflexive? Like, are those two components that make markets highly reflexive?
It makes them more reflexive. It makes them more volatile. So because and I've seen you talk about it. I've talked about it, right? With Bitcoin, using Bitcoin as a specific example, we have paper Bitcoin, right? So we have all of the futures, we have all of the leverage that exists in Bitcoin that allows people to essentially bet more Bitcoin that exists on price going one way or the other. Now, what happens when that unwinds one way or another? That creates a lot more volatility in the market, right? Still reflexive, but also creating more volatility. So, when it comes to um, how reflexivity plays in the market, just like volatility, reflexivity cuts both ways. And there's really no way around that relationship. And there's really no way to avoid that nature. So, when it comes to leverage, when it comes to the futures market and paper Bitcoin, when it comes to the degens that are using 100x leverage, it it all plays into the price action around Bitcoin, which is why when people say online, "Well, Saylor's buying all this Bitcoin. Why isn't the price going up?" He doesn't make the market. One, he is buying Bitcoin in a way that is specifically designed not to move the market. He's buying it OTC, right? So that's the first thing. The second thing is, how is he supposed to counteract all the leverage in the system? He can't, unless he can't buy 42 million Bitcoin because he can't possibly do that. So he is a market participant just like us, just like Strive, just like Metaplanet. All these treasury companies that are buying up all the Bitcoin that are acting as a consistent bid on Bitcoin, they still are market participants. They're not market drivers.
Yeah. I saw this tweet the other day, I think from Eric Weiss. He brought up the idea that there was a significant amount of paper Bitcoin out there, or rehypothecated Bitcoin. I may have been like the phrase that he used. Do you think that is the case? Like, I think he even suggested that Bitcoin should be $250,000 per coin right now if it wasn't for this. Do you think that's the case, or do you think it's kind of like a scapegoat because price is underperforming?
Oh, it's absolutely 100% a factor. Absolutely. By the nature of futures, by the nature of paper Bitcoin and all the leverage that exists out there, you can make bets with more Bitcoin that exists, right? Fundamentally. Obviously, we've seen this be the case throughout Bitcoin's history. There have been events, there have been narratives, there have been periods, either after halving, after the liquidity injection from governments or whatnot that have driven Bitcoin's price up over time. What that has been is kind of like I said, that volatility in the market is tension that exists between positioning. That was an event where positioning was driving price up, where there was enough positioning to drive price up. However, the opposite is true as well. Just as much positioning, if not more, because remember, what we have to remember is the world is probably more short Bitcoin than they are long, because it's a fundamentally new form of money. It's a fundamentally new technology. It's a fundamentally new um, asset and commodity that exists. The world is going to be likely more short Bitcoin than they are long. So what happens when there's opportunities where price starts to drip down? That same amount of leverage, if not more, comes into the market through futures, through paper positioning, through leverage positioning to push price down as well. So if it weren't for paper positioning, if it were just a matter of buyers and sellers, no leverage, no paper Bitcoin, no futures, I absolutely 100% think Bitcoin's price would be exponentially higher than it is right now.
But yeah, I mean, that makes sense. I guess the question is, how much exponentially higher would it
Well,
be? You know?
that I don't know. It
Yeah.
I can't. So here's the other side of that too. Because of all the leverage and because of all the paper Bitcoin and because of all of the other factors that exist in the market, that's actually part of the reason why Bitcoin's market cap is as high as it is right now. So without all of that, we may have in some ways had less volatility as adoption grew. But on the flip side, we can say that adoption would not have grown without that volatility. So, like Saylor says, volatility is vitality. It's very, very true. Without the leverage in the system, without the paper Bitcoin in the system, we wouldn't have attracted the level of investment in the first place, which wouldn't have made Bitcoin this as large as it is right now. So while I think Bitcoin could be potentially larger, and why I think it could be exponentially larger, I can't fundamentally say how much so, because if I'm being honest, it cuts both ways. But if we were to remove some of the leverage from the system, I think the price would be much more stable, and I think it would be much likely to go much higher.
Yeah, that's very interesting. You also kind of point out that, like, okay, we know that Bitcoin has a fixed supply cap of 21 million. Like, that's kind of objectively true, or at least it has been true. But you argue like that fact alone doesn't tell you whether the price of Bitcoin should be $10,000 or $10 million. Like, can you kind of expand on that and kind of the way that you're thinking about markets in general?
Sure. So when it comes and that's kind of similar to what I did with the example about cost of production, right? A Bitcoin miner mines Bitcoin for X amount of dollars. That doesn't say what the market's going to rate it at. Similarly, Bitcoin's fixed supply cap, that doesn't say what it should be what it should sell at. What's going to determine that is the market. The Bitcoin's fixed supply cap, if we just think about it very, very logically, just because Bitcoin has a fixed supply cap does not mean it should be exponentially more valuable than everything else. It's fixed supply cap when enough people agree that it should be exponentially more valuable than everything else is what's going to drive that exponential value. As more people come in, as more people buy it, as the price goes up, and as more and more and more people come into the network and more people adopt Bitcoin, that's when the fixed supply cap starts to exert exorbitant amounts of force upon market dynamics with Bitcoin, right? But we've just seen with the price sell off, the fixed supply cap didn't prevent it from going down. So why would the fixed supply cap dictate that it should go up? We need the narrative, we need the market participants, we need the sentiment on our side to justify that. And that is why that's why I said in the essay, and that's why I tell people, the fixed supply cap is great once we have the narrative and the market participants to back it up. As of right now, and in general, fixed supply cap doesn't say it should be more valuable. That there's no objective reason why that should be make it more valuable. And people like to say that Bitcoin has intrinsic value, that because of these properties, it is true whether people believe it or not. Okay. That still comes back to the same fundamental understanding. How many people believe it and how many people don't believe it? And how many people are allocating capital towards it? And also for the argument towards Bitcoin's intrinsic value, I have another thought experiment in the essay that I call the disconnected individual. And I tell people, you and I might think that because of Bitcoin's fixed supply cap, because of its anti-fragile nature, because of its network properties, because of the fact that it's digital, because of the fact of so on and so on and so on and so forth, we think Bitcoin is incredibly valuable. Okay, so what about someone in Africa that doesn't have internet access, or South America, or rural China, or the Appalachian Mountains? What value is a digital commodity to them? Zero. And that is what comes into the notion of how markets act and how markets react and how valuation operates. It is not about what you think you can objectively justify. It is about what the market perceives it as. And that perception is driven by sentiment. That perception leads to judgments about how to allocate capital and it leads to conviction to actually allocate the capital. That is how all of this kind of coalesces together.
Mhm. Yeah, I agree with that as well. Another thing that you talk about is the efficient market hypothesis. Maybe can you express your ideas around that and how it relates to market sentiment?
Well, the efficient market hypothesis, and without going through the strong, semi-strong, and weak forms, very, very simply, it says that markets are efficient because information flows to the market efficiently, and all things in the market are known. That's a very, very simple way of describing it, right? But the flaw of the efficient market hypothesis is that it equates the availability with information with the uniformity of interpretation. Just because information is available doesn't mean everyone's going to interpret that information the same way. The efficient market hypothesis also doesn't take into account proximity to information. People, hate to keep using Michael Saylor as an example, but it's the example that most people watching this would know. I've often heard people say Saylor knows something. That's why he's buying up all the Bitcoin, right? He knows something that we don't know. That's informational proximity. He is closer to decision makers. He is closer to the power brokers of the market. He is closer to politicians, to CEOs, to boards of directors, so on and so forth. He may be hearing things, he may be receiving information that we don't have because he is closer to it. He has informational proximity. The efficient market hypothesis doesn't account for informational proximity whatsoever in its entire theory. There's no accounting for informational proximity. And as information moves through the market, it's going to dilute. I don't know if you recall when I was a kid, there was a game with a string attached to a phone, right? And we would talk to each other back and forth and pass messages. And the first two people that pass the message by the end of the whole exercise, when you get to the 29th and 30th people that have passed the message, there's a different message. That is how information very simply degrades as it moves through space and time. So information is not only not going to be efficient, it is not only going to be interpreted the same way, it is not only going to be limited by proximity, information is also going to degrade as it moves through the market. Because we've seen the short and distort reports for treasury companies, right? We know something is factually inaccurate because we're watching these companies. The short and distort report, whether it be by Carousel Capital or whoever, still comes out, still puts a spin on the very same information that we are privy to that then moves the market. Same information, different interpretation. And because of Carousel's footprint, their informational dissemination hits the market far quicker than ours will.
Mhm.
And people that are closer to information, that are closer to decision makers, they're going to hear and see that information before they hear and see the counterpoint coming from us, aren't they? That is why markets are not efficient.
Yeah. I definitely agree that markets are not perfectly efficient by any means for a variety of the different reasons that you just pointed out. But would you argue that like free markets are the most efficient way to allocate capital? Like prices are the most right rather than centrally planning the prices from one entity or one person
Most right compared to what?
compared to if one entity, I guess there is no necessarily, one correct price, but if one entity was trying to set the price of everything, would that be a better way to which way is a better way to allocate capital?
Well, that's kind of one of the flaws in EMH, and it comes down to roles critique, right? So the EMH assumes, and again, I'm trying not to get too technical and lose the audience here, so I want to give a very general example. To quantitatively validate the EMH, they use something called the market portfolio, right? Now, conceptually, the market portfolio is literally everything that can exist in the market.
Mhm.
That is all capital, all assets, all commodities, theoretically, all collectibles, tradables, and in theory as well, all human potential and potential human capital. That would be the market portfolio to really see what the market truly should be worth. However, that is impossible to do. So they typically, when people espouse EMH, and when Fama originally proposed the EMH, and Fama's other, um, I would say, addendums to the EMH, they've used the S&P 500 as a proxy for the entire market portfolio, right? Now, that creates a huge problem, and here's how it's going to feed into what your question is. If your entire market hypothesis is driven upon this notion of the market portfolio, but you then don't validate those ideas against the market portfolio, you've then shifted the goalpost from what it should be to what you think it should be to what is actually something you can validate. You've just stripped away all the validity in your entire analysis by doing that. That's the first problem. The second problem, coming to your question, is efficient as opposed to what? If we have nothing we can benchmark it against, we cannot assume it is the most efficient. It is just what we know. It is just what we are familiar with. It is just what everyone assumes is the best model. So, to answer your question, is it the most efficient that it can be? Sure, we can say that, but that does not mean it is the best model. It is just the model that we know.
Yeah, I think that makes sense. How do you also think, I've seen stats of like the typical person or even like the typical fund like cannot outperform the S&P 500. Like most, fail to outperform the quote unquote market or the S&P 500, which is like a typical benchmark for the broad market, even though it's not perfect. What do you make of that just general idea of like how difficult it is to outperform like the quote unquote market?
Well, let's come back to your Warren Buffett example. He's been doing pretty well.
Yeah. But he's
And
he's very select few.
right, but think about what I've been saying about informational density and about understanding what it is you're actually looking at. His process is the most austere out of all processes that we currently see employed in the market. He's trying to remove as much noise as possible from his decision making process, which is probably why he's been outperforming the market. His decisions aren't sentiment free, but they are less sentiment rich than others in the sense that his sentiment is informed by his market experience and the informational density that comes with that experience. It's just that his sentiment has been more right than it has been wrong. But even using him as an example, he's missed out on Apple, he's missed out on Nvidia, he's missed out on the entire Mag 7 essentially. He
Mhm.
told Bill Gates to sell off his Microsoft shares and become diversified. And if Bill Gates had held those shares, he'd be a trillionaire right now. So even in the event of someone that's outperforming the market, there's still stuff that facilitates the understanding that you can't outperform the market every single time. But that being said, he has outperformed the market. And
Mhm.
the efficient market hypothesis will say that, that can be an artifact or that can be like survivor bias or something like that in the market because he's been in the market so long. But I think what it is that I don't know if in his heart of hearts, Warren Buffett thinks that markets are efficient. I think Warren Buffett assumes that markets are inefficient and markets get irrational. And what he's trying to do is that he's trying to position himself and benefit from that irrationality and exit before the rationality pivots backwards. which is probably why he's sitting in over what 350 billion in cash right now.
Yeah.
He thinks the market is like, okay, the market's kind of hot right now. All things being equal, in a case of probabilities, is it likely to rip higher another 2x, or is it likely to have a correction? He is going on historical convention. He is saying it is likely to have a correction, so he is exited and he's waiting for enter when the market does correct.
Mhm. So on this topic of passive index funds in particular, as more like because obviously ETFs have exploded over the last, I don't know, 20 years, and Vanguard has obviously become like a household name. And now, like the traditional, like instead of putting money in a savings account, obviously many people just plow money into the SP 500 or whatever. Do you think that that creates like problems for the market? Does that create more market inefficiencies? Is that going to like create weird externalities? Like, how do you think about that?
So when it comes to passive indexes, whether it be passive allocations or whether it be mandated allocations based upon a particular fund or what have you, those are still price takers. They're not price setters. So they're still downstream of sentiment. They're still going to be taking the price of the most marginal, the marginal price that they can get based upon their price targets or what have you, right? Or they may just be buying it indiscriminately at whatever price it can be, but they're still a price taker. They're not driving the market. What I do think is that as algorithmic execution becomes even more prevalent, and as these different indexes and these different ETFs become more and more prevalent, what we're going to see, and this is just me spitballing, what we're going to see is one, more indiscriminate buying of the quote unquote winners. So, Mag 7, pharmaceuticals, so on and so forth, which can drive disproportionate capital allocations in the market. However, as a result of that, I think the crashes we can see will also become more violent. If everything is going to be passive allocation, if everything is going to be algorithmically driven, if everything is going to be um, what people assume is objective and human hands off, as I've already explained, all of these algorithms, all of these allocations, all of these capital allocations are being driven by assumptions that are driven by historical information. But you know, there have been cases where, and I'm sure you've seen, margin call, and I'm sure you've heard about, you understand the what drove the GFC. They were operating under assumptions that were driven by the historical VAR models, right? And once those blew out, they were well outside of their risk profile. Now, the risk profile itself was also based upon historical information. So the question I pose, and hypothetical I can see is, when you have a market that's being driven by historical assumptions, and when you have allocations being driven by historical data, but at the same time you have algorithms that execute in the market at the speed of light, what happens is unwinds become very, very violent and very, very sudden. So I think, ironically enough, like I've been saying, algorithms and passive allocations, all they do is they amplify the footprint of sentiment in the market, and they create more of those ripple effects. It's just that now you have instead of a stone, you have a boulder that can be thrown into the market and create its own ripple effects as well. So it doesn't absolve sentiment, it in fact amplifies sentiment. And if everything goes passive allocation and ETF, I think that the notion of this stabilizing the market may be a bit hopeful. And I think that if anything, it just creates concentration points where unwinds to become very, very violent.
I agree with that. It's very interesting to think about like what are the implications of passive investing, because it's kind of just kind of a weird. It's hard to answer correctly. We may not even necessarily know the exact implications, even though I do agree with kind of how you just thought about it right there. Um, Maybe we can start to close it out with topics on digital credit. Like, how does digital credit kind of tie into one, I guess, how are you thinking about digital credit? And then two, like, how does it tie into your paper as well?
Well, if you think about it, so let's use the four most. Well, we can use five, but I'll say four. The biggest ones there from strategy, right? We have strike, we have strike, we have strike, we have stretch. Okay, all of them are supposed to be at $100 par. So let's think of $100 kind of like what I've been expressing as parity. That is the fundamental parity. That is the one to one for those preferred offerings. But yet still we see strike and stride trading below. Strife at sometimes is traded above, but I think I haven't checked recently. I don't know if it's at 100 or below. And we have stretch that has been doing very, very well, right? It's been at like 99.99, 99.98, 100.01. Do you see what I'm saying? So it's been very, very good. So we have four different offerings, four of them that should be trading at $100 par, but only one of them is trading around par, while the other three have been fluctuating or have been well below par. I don't really think there's a fundamental justification for that outside of how the market perceives them. The market perceives stretch as a monthly dividend that is supposed to be less volatile, that is supposed to be something that can replace a savings account, that can be something that they can park their cash in, get a dividend on it, a dividend that is return on capital, no less, and just park their money there and get a dividend and get paid for it and beat inflation, beat savings accounts, beat whatever, right? It's a very, very attractive offering. Stride, they've described it as a junk bond. It's supposed to be more volatile. It pays quarterly, and you're going to get more exposure to that potential price appreciation, but you're also going to be exposed to that volatility as well. Strike has a convertibility factor to it. You can, in theory, convert it to MSTR shares at some point. It's going to be somewhat more volatile, also paid quarterly as well. Then you have Strife, paid quarterly, supposed to be more like a bond, right? It's supposed to be more stable, not quite as stable as Stretch, but more stable, that pays quarterly, and it's supposed to operate like a bond that you can hold over time. Those are four entirely different offerings that are going to have four entirely different potential investor bases that are going to have four entirely different market perceptions. And I think what we're seeing right now is if I can be so bold, a very, very clear delineation of how sentiment affects markets. There's no reason fundamentally why they should trade below their stated value if if all things being equal, other than we have correlations with how people perceive Bitcoin, we have correlations with how people perceive strategy, and we have correlations with how people perceive the offerings themselves. All of those, that's sentiment driven. That's perception, that's judgment, that's conviction. That's conviction. How people are perceiving it is determining how people are judging them, and how people are judging them are determining how people have conviction upon allocating capital towards them. And people have a very, very hard time accepting the fact that the market is sentiment driven because they think everything is objective. But again, if everything is forward looking, people are not allocating capital to stretch today because they think it's going to benefit them today. They're thinking about, I'm going to get the dividends next month and a month after and a month after that. Same thing with all the other offerings. And it's just that the market doesn't have confidence in those other offerings right now. They're still building out their narrative. They're still becoming steady state. But I think that is a very, very clear justification of my thought process around parity. They should all be trading at parity. And if they all trade at parity, they would all pay the dividend, but we're still seeing that the market doesn't care really when it comes to that.
Yeah. Adrian, this has been a fascinating conversation. Definitely different from a lot of the shows and podcasts that I record. So I think this has been good. We'll post a link to the report so the audience can go read the full paper in depth. Is there anything else that you like want to leave the audience with? Maybe something I didn't ask you. Anything that you kind of just want to share?
I would say that to people that are watching that are Bitcoiners, that are strategy investors, that are Strive investors, that are or whatever. I understand that the price action right now isn't what it, um, what we hoped it would be, what we thought it would be. But as someone that's been in the space since 2012, let me assure you, I have experienced pain in the markets many, many times. So if you can weather this storm, if you can hold on, if you still believe in the thesis, if you still are a believer in the narrative behind Bitcoin, then I think that we'll be fine. It's just that you have to weather the storm. And right now we're going through a storm. Right now we've got all kinds of macroeconomic and geopolitical factors that are playing up in the market. We can't possibly understand or predict what's going to happen. We just have to stand pat. And if we have conviction, we have our allocations. It's just a matter of waiting out the market.
I like that. Weathering the storm. It's a good spot to end. So, Adrian, thanks so much for coming on. We'll have to do this again at some point.
Thank you for having me on. It was a pleasure.
Awesome.